Welcome to the Money to the Masses podcast, putting you in control of your finances. It's a good thing podcasts are free, as this one isn't worth a penny. Here are your hosts, Damien Fay and Andy Leaks.
Now, Damien, before we get on with this week's podcast, you had something quickly to say about our sponsors.
Yeah, we've got a new sponsor, Money Farm, and Money Farm are an online investment advisor and one of the biggest digital wealth management companies in Europe. So a big thank you to them for sponsoring the podcast. Now, Money Farm create portfolios to maximise long-term returns using ETFs to make incredibly cheap portfolios. And you even get the first £10,000 of your portfolio invested without any charge from Money Farm. And if you enter the code MTTM20K into the box when you sign up, you get the first £20,000 of your portfolio invested and run by moneyfarm.com without any charge.
Great stuff. On with this week's show. Hello and welcome to episode 122 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, how you doing?
Brilliant, Andy. We are in the same room.
We're on the same mic, we're in the same room. Actually, can you get off my lap?
I was almost going to tap your leg there, which would have sent you into a scream.
No,
but,
I like it.
We are in the same room. Unusually so, actually, because most of our podcasts we record remotely.
Yeah, we went into the digital age about, 18 months ago, and we've never looked back.
We've never looked back, and well, I suppose it kind of leads nicely into what we've been doing this week.
Yeah, well, why don't you tell listeners? It's exciting stuff. I'm excited for you.
It's exciting because for a while now I've been sort of dropping odd little teasers about a new podcast project that I'm working on, all related to Money to the Masses, and haven't given you a lot of detail, and so I'm going to give you a little bit more, because the reason why Andy and I are together, because there were some bits we were working on this new podcast, because I've finished the work that goes behind creating it. What the new podcast I can reveal will be called...
Oh, drum roll, here we go, one sec. Okay, continue.
The One Giant Leap.
Brilliant.
And that's the name of the podcast. A lot of what we do on Money to the Masses, we talk about money, don't we, Andy? And I do a lot of work on the site. I teach people how to invest, run their money, from things including simple money tips, but to the full-blown financial planning stuff. And one of the things is that there's money savings part of the equation. Running your money and investing it to make it grow is another. But a real important part that no one really ever deals with is the idea of how to make more money. And we touch upon things like that when it comes to simple things you can do on the side. I don't know, people do survey sites and stuff. And what I wanted to do was try and inspire people to do what I've done, really, is to take a passion and then turn it into something, and turn it into, ultimately, you don't know where it could lead, and it could be your job like mine. For example, my story, as most people listen to this podcast know, very brief, is that I'd worked in the city, got fed up of the way it ran. I was making rich people richer. I couldn't afford my own hourly rate, and then jumped ship and decided to start writing a blog that giving away stuff for free. Fast forward 4 years, I had to quit my day job to do this full time, and it's blown up into the amazing entity that it is now, moneytothemasses.com. But what I wanted to do was inspire other people, and so the way I could do that is to tell that story. But it felt a little bit more, a bit of sort of, I don't know,
self-indulgent?
Self-indulgent, they're the words I was looking for. So I didn't want to...
words I would never associate with you. You're the most sort of laid back and sort of... You never push yourself enough. It's the complete opposite to how you are.
Funnily enough, other people say that. Modesty is...
That's the word I was looking for.
Well, it's funny to say you're modest is actually not particularly modest. But the thing is, I find it difficult to talk about what we've done, but I really want to inspire people to do the same thing, because it's a very difficult industry to go the finance world, to turn it upside down, and actually now at the point where all these big companies are wanting, FTSE 100 companies are trying to knock on our door, where obviously when we started, nobody wanted to give you the time of day. So what I wanted to do was go and find other people, ordinary people, because to be honest, Andy, you've known me for years. I am very ordinary.
Extremely so.
Extremely
frustratingly so, yeah.
And to inspire people to be able to... that they can do it. So the people listening to this podcast could go and do something by following a passion, whatever that is. So you might be into knitting, you might be into cake making or whatever, and you could follow a passion and turn it into something amazing. And so I decided to go and find some people out there who are equally not rich or wealthy. They're people who've had an idea or passion and followed it through. So I'm not going to give too much more away about the podcast in terms of the people, but I've interviewed 9 people for this podcast. They're all done. They're in the can. Andy's doing a marvellous job editing. And I go and interview these people and talk about their stories and about how they've followed this passion, and it's something that's amazing. One example I will give you, there's one of the guys who will be the next big thing you see on TV. I've actually seen him on TV already since I've interviewed him, and he decided he was incredibly overweight, 23 stone, unhappy, depressed with life, and he decided to take a leap and try and get onto the front cover of Men's Health magazine within 3 years. Well, anyone who knows what that looks like, that's bodybuilding material, sort of amazing looking, and he did it. And then now he created a business. He worked in IT, but he created a business that deals with dieting and helping other people do that. And now he's created a new diet that's now going to be on telly and everything. It's an amazing, amazing story. You have to listen to them all. There were so many good ones. There were people who have battled, like I say, depression or just followed passions. They're taking on multinational companies, helped homeless people. And the reason of the name, the One Giant Leap, which I haven't explained, is that there was a point where I was doing Money to the Masses in my spare time, and I had to then go full-time on it. It was something in the background while I worked. And there is that point where you stand there and it's like being on the edge of a cliff and you decide, I'm going to leap off into the unknown and hope that something's going to break my fall on the way down. And it was trying to get that moment. That is the moment that stops people trying to do anything. It was the hardest thing I ever did. It's also that moment bit before that where people won't even start an idea or try and explore it because of fear of failure. Those are things that are I remember the feeling, and you still get those feelings. And I want to inspire the whole of the UK to start going out there and trying something. You can do it. It doesn't cost you anything on the side. You can try ideas, because the big thing, people may have heard me mention it before. In America, they have the American dream. It's very entrepreneurial. In the UK, we are brainwashed to be 9 to 5, to do a career, to own our houses, all these things that are just putting you into boxes. We need to be inspiring the next wave of entrepreneurs, people to try and do something, because that is good for them, their well-being, their happiness, the economy. It's good for everybody, and this is my attempt to do that, because we don't have anybody really doing it in the UK. So hopefully I've got everyone excited. Next week I'll tell you a bit more about the podcast, how you can sign up and where you can go to look for it, etc. Because we're going to launch it very, very soon, and everybody who listens to this podcast will need to know how they can go and find it, sign up and listen to the interviews. But they are amazing.
And excitingly, our listeners are the first to hear about it. This is the first time publicly you've talked about it to other people, and so they're kind of getting a bit of a sneak peek and a scoop. And actually next week we can play a little clip to one or two of the episodes as well.
Exactly. And I've not mentioned it to anyone before, only the people who've been interviewed, and there are, like I say, some amazing people, but it's a very separate thing to what we're doing on this podcast. It's like complementary. It's a slightly different area, and we're doing it in seasons. So if I really want people to support it, because I want it to be very big. I want it to encourage young people, because we've got I interview someone who's very young who went on to do some amazing entrepreneurial things, and so there's something for everybody. There's somebody for people who are older. There are people who are suffering from, like say, depression or down on their luck or hate their job, and all this. There's something in there for everybody.
Good. So, One Giant Leap podcast. More on that soon. Exciting stuff then. What have we got on this week's pod? Back to Money to the Masses now.
Back to the core. Money to the Masses. Right, I've got 3 things, which is the usual, but 2 of them have come again from listener questions. And actually, it was quite good, because last week when we were doing the podcast, I mentioned getting in touch on Twitter, asking me questions on Twitter, because I'm always on Twitter and it comes straight through to my phone, and people did, which was brilliant, and I had some great exchanges on there for regarding various different things to do with money. But it's quite nice because you have quite succinct conversations and get to the point. And so yeah, please do that, even if you just want to say hello. It's Money to the Masses with the number 2, so Money to the Masses.
And just to confirm again, Damien hasn't got a tranche of employees under him that are sort of going through, screening these messages and sending back on his behalf, it is Damien. It goes in his pocket and he's there. And he's normally getting a train or getting some sort of minor operation done.
Yeah, like the last time I had a minor operation and someone did it. It was good fun. Oh, I'm sitting on the toilet. So
I was going to go that was number 3, but actually it's normally a number 2 you go for. But
yeah, I have Crohn's disease, Andy. I spend my life near the toilet. That's too much information. So let's go with the first one.
Yeah, what we got?
Right, the first one actually is based around investing. And somebody wrote in, and I've not got their name because I've misplaced it, but they asked about Hargreaves Lansdown. Okay, for people who don't know, they are a FTSE 100 company. They're the biggest platform provider, so they're the biggest broker in the UK. So if you want to buy and invest in funds via an ISA, a SIP, or directly, or you want to buy shares, Hargreaves Lansdown are the name that's out there, and they're very good at what they do. And understandably, that's why they're so big. But they also try and launch their own products, which is slightly unusual for a platform. And they are just doing a big piece on launching a new fund. And the fund essentially invests in shares, a very small number, so it's quite concentrated. Most funds could have hundreds of shares from different companies. They're going for a very concentrated mix of about 30 stocks. And they hit the headlines because their aim is to produce an income. So it's an income fund.
Okay.
And so there are many of those out there, but they're going down the route of making it incredibly cheap, which is, some might argue, is a new dimension for Hargreaves Lansdown, trying to go down to make it the cheapest. In fact, this fund is going to be cheaper than 90% of the UK equity income funds out there. So somebody wrote in to me and asked me, should they buy it? And should they invest 10% of their portfolio in this fund? So I'm going to answer that question generically and link into some research that I did this week for 80/20 investors. Obviously, I'm not going to give away the research, but just touch upon some key bits that people will find useful. For those who are new to the podcast, 80/20 Investor is my DIY investment service where I teach people to run money. Actually, Andy, just reminded me, today is the 2-year anniversary of me running my live £50,000 portfolio on the 80/20 Investor.
Happy investing birthday for you.
Yeah, and the reason that's important, or is a key date, is that the longest subscription model that we do, because it's you can pay monthly, or you can pay an annual subscription, or you can pay for biennial. And actually the biennial makes it only £12 a month. That's what it equates to in price. And so it was really evidence that by doing it for 2 years when I started to today, anyone who'd followed me, what would have happened? And I'm going to push some other pieces out. I might come back to it next week properly, but we outperformed the market. I basically turned £50,000 into just shy of £60,000 in 2 years. And so I'm really chuffed with that, beating passive trackers, the market, professional fund managers. Brilliant. I was looking at those numbers as we were getting closer to March, because it's that 2-year anniversary. We might do a full piece on it. So go and have a look, do a free trial if you are interested in learning how to run your own money. And it's obviously it's a fantastic service, and it's something that I get so much great feedback about. But I've diverted. That's the point. The question was, should they invest in this new fund? Now, the first thing I would say to anybody is new funds are always, they're unknown quantities, so you don't know whether they're going to achieve what they set out. So what happens is that with a fund like this, they will turn around and they will say, we're going to aim to produce an income of, say, it's actually just shy of 4% they're aiming for yield. So that means that theoretically...
In terms of their ambitions, how does that sit with you? Do you think that's ambitious, or do you think that's about right for the current... I know it's a $1 million question.
No, I think it's a good question. I think it's what they'd have to do, because... if you think that the FTSE 100 at the moment has a yield of 3.76%, so if you don't know what that means, in very simple terms, that would be if you were to put, for every £100 you invested in shares, the dividends would equate to a gross income of around £3.76.
Right.
So if you scale that up, if you had 100,000 in there, it'd be about, you get £3,760 a year. That's the idea. So if you're going to invest in an equity or create an equity income fund, that's a benchmark. So they're going for just above that. But interestingly, if you're going to make an equity income fund, you're not restricted to the 100 top companies in the UK. You can go anywhere. And so a number of the equity income funds do just above 4%. The average is actually 4.06. And of course that changes. It's based on yield is a measure of the income versus the price. So at the moment that's the yield. And so they're pitching it roughly at where the average is anyway. So they're not shooting the lights out or anything like that. But that's a realistic target. So if the thing is, if you get a new fund that comes along, then it's very difficult to know whether to invest. Now, an income fund can be slightly different, I suppose, because if that's what they're aiming to achieve, it's not quite the same as someone saying, I'm going to grow your money by X amount. That seems slightly unrealistic. You can buy a share and it has a sustainable dividend already. It's got a good history. It might be a little bit easier, theoretically, to actually achieve that aim rather than saying, I'm going to double your money, to say, look, I'm going to get a 4% income out of these shares when they already produce that. It's a little bit easier, if that makes sense. Yeah. So, getting back to the point, should you invest in it? My view is, and it's a very personal view, that I always invest in for income. I would invest on the basis that the fund has a record of growing its dividend or its payouts. Because there's no good you buying a share or a fund that pays you a yield today that next year they might cut that because they've invested badly, so the payouts dropped, or it doesn't grow, because the problem is inflation is always around, so inflation is going to go up, so you need that to grow. So if you're going to retire, it's no good if you're going to retire in 30 years' time, you need it to be paying you more money, because in real terms, if it didn't, then you would actually be able to buy less with that money, if that makes sense. So you need it to grow year on year, and the only way to do that, realistically, is via equities and equity income. So linking this to a piece of research I did this week on 80/20, somebody asked me, how would I personally build a portfolio to generate an income that was not only diversified across asset classes, but globally? And so I did a whole piece on it, and it was really fascinating to do. And I came up with a portfolio at the end of it that produced a yield of 4%. But it was invested in bonds, it was invested in property, it was invested in equity. So it was actually meant that there theoretically should be a more stable income stream, because you're diversifying. It shouldn't plummet. The capital value shouldn't plummet as much if the market dips because of different assets. But one thing I would say to people is, if you're investing for income, then you shouldn't obsess about the capital value as much. You'd like it to grow, but as long as it's chucking out the income and you're living off that and that income's growing, it doesn't matter so much about what the capital value's doing, because your income is paid based on the number of shares or your proportion of the fund that you own. It's not worked out on the share price. So you own a share, you will get paid. If it's 3p per share, you'll get your 3p. So it doesn't matter what the price is directly. So going back to their question, would I invest in it now? Probably not. I mean, lots of people will do, because Hargreaves Lansdown have such sway. I'm not saying it's a bad thing. I'm just saying that I probably wouldn't necessarily wade into it. There's lots of options out there. The one good thing about it I do like is it's very cheap. Now, the average cost of it is 0.6% annual management charge, which is very low, which is why it's so cheap compared to all the others.
Why have they done that, do you think? Is there a specific reason? Will they tell you?
Well, the reason they're doing it is because they're realising the market's becoming cost sensitive.
Right.
And so lots of people are looking at things, and the press want things to be cheap. And actually, I sit on the fence. Cheap is good, because the one factor you control in investing. So charges eat into your returns, but it's more about the net returns that are more important. So if something's expensive but it delivers, then it nets out. It doesn't matter so much. So they've gone for that cheap angle. But interestingly, they're not the cheapest equity income fund out there. People listening to this will realise that I often mention them. Vanguard.
I knew that word was going to come. I've learned something in this podcast.
They do one, and they do a FTSE UK equity income fund. That's what it's called, and it's a bit cheaper, and their yield is at the moment 4.6%, so it's a bit higher. And I think it's a great idea from Hargreaves. I love the fact that they've made it so it's a very small number of stocks, so it doesn't over diversify things. I think there's a danger of that. The overall cost for it does jump up to about 1% when you add in their platform charge. But I suppose my answer to this person is, you can build, if I'm investing for income, if that's what she's doing, then I wouldn't put all my eggs in one basket, because there are other ways you can do it. You could invest in, like I said, bonds, property and equities. Very quickly, bonds don't pay a growing income generally, and they actually they're unlikely to keep pace with inflation at all. Property does a little bit more, but then you can realise why, because if most of the income is generated from rents, landlords love putting up rents, and it's commercial property we're talking about, so that's why that grows. And obviously for equities, companies grow, they get more profits, the aim is that they will grow and therefore they'll pay bigger dividends. So I would personally build a portfolio of equity income funds aiming for a minimum of 4% on as a yield, but only focus on those that have reliably paid dividends for a number of years. A minimum of 3, that's my benchmark. But I prefer to see a history of 5 to 10 years and can see, have they been increasing it year on year, or if there has been a dip, how much by. And that is all part of 80-20. I do a whole thing on that. So people have these wonderfully coloured heat maps, so they can look at them and just see, oh, okay, that's all green. Brilliant, I can go for that one. So that's my tip. Don't necessarily go in straight away. See what it does. Let it go for a year or two. And there are plenty of other alternatives. If it's cheap, there's cheaper alternatives, but there are some brilliant equity income funds out there anyway. Oh, one quick thing I'd add, because somebody did mention to me that one of the things, it pays monthly, which is obviously quite nice. You get a monthly income from it, come from the fund. And lots of equity income funds don't. Like the Vanguard one, I think, pays every 6 months.
Right.
So some people go, well, I can't pick that fund because I want my income monthly. But what I would say, again, to anybody who's investing for income, what I do is I would put a pot of money that was equivalent to your income you need for a year and live off that in cash, and then allow the natural dividends and payouts from your portfolio of income, shares or funds, to fill that pot up. And then when you get to next year, you can start drawing on that. So you don't have to worry about the timings, because they're all dropping in during the year. By the time you've spent your first year's worth of money in cash, you'll get to the point that your pot's top back up again. Anyway, that's another tip.
It's a very good tip. Okay, what we got next?
Right, somebody asked me, just to paraphrase, they are retired, they have some money they've taken out or in their pension, and they are debating whether, I think they've taken some as tax-free cash, and they're debating whether to invest that money. And their question is, should pensioners invest in the stock market? And, I mean, it's an interesting question, and yeah, I mean, why not? The thing is, with investing, is that you have to satisfy your own what you're trying to do. So are you wanting to draw the money and not take any risk, in which case investing in equities probably isn't a good thing, because the market could drop overnight and suddenly you've lost your life savings. If you're trying to go, it's a very good link actually back to the previous piece. If you're trying to get an income stream, a growing income stream from an asset of some kind with that money that you have, then as a pensioner, investing in things like equity income funds, like I just talked about in the previous piece, can work really well, because you're not so bothered about the capital value moving up and down, because as long as you get that yield, that income. So yes, absolutely, why not? There are people that do. The only thing is you have to be comfortable with the risk. Now, if you're going to do it to try and grow a pot, I would always, a very good steer is something I come back to time and time again, is this age guide. Now, if you take your age away from 100, and that is the amount of high risk or something that's not low risk level of investment you do. So let's take me. I'm almost 40, so let's say 40. So at that rate, I can take a 60% high risk or medium risk investments. So that'd be in equities and things like that, but 40% should be in things like bonds and cash or property and stuff like that. So that is how, very benchmark and very loose, that quite a lot of people run money, even in the city behind the scenes. That's the sort of steer. So somebody who's 60 doesn't want to be, and they're medium risk, so they don't mind a bit of risk, but they're not risk averse. They wouldn't probably want more than, say, 40% in equities or anything like that, because they might be taking way too much risk. So the idea being that as you get to 100, if you were to live to 100, you wouldn't be taking any risk. So because you want it all in cash. So I hope that makes sense.
Yeah.
So I would say to people, when I got to that age, I wouldn't necessarily be overtly investing in the stock market to necessarily grow my money. But if you had to, because the problem is it's more about when you need to draw on it than about your age. So if you're 60 and you plan on drawing from the money till you're 70 because you've got other means to live, then why not invest in the stock market? You've got time in case there's a correction to try and make some money back. So it's more about when you need to take the money rather than your age directly. But where your age and your risk profile comes in is determining how much you would put into risky investments. So as you say, as you get older, so if you're 60, you probably would only have 40% in equities, but as you got older, you'd probably have 0. If you got to 100, you'd have less and less. But it's horses for courses.
Okay, so last piece of the pod, what we got?
The last piece of the pod.
I like that.
I do. We've never said that. We've done 122 episodes and we've never said the last piece of the pod. This one is just something that has come up recently. Do you remember, I think 2 or 3 podcasts ago, we did something on energy and people switching their bills. And it's still people don't, and there's been lots of stuff in the press about it. And I just stumbled across it the other day. I didn't realise there are now... the wonderful thing about technology is that people keep innovating and trying to change people's behaviour and make it easier for people to do things, like lowering the barriers. And one of them is, in terms of switching energy, you've got to do comparison sites. And we did some Lazy Ways, which was a very good podcast. Go and listen back about how you could do it. But there was actually another way that's just come to my attention. I haven't used the services, and so I can't say if they're good or bad, but I've seen some press coverage for them that has been positive, at least for the idea of what they do. There are some sites now that you can sign up to that will just flip your energy bills for you when you can save a certain amount. So as an example, there's a company called Flipper, and they will flip you to a new deal automatically, as long as it's at least £100 cheaper than the one that you're on. So it will just keep moving you around as long as the savings exist. And of course, there is another service that works in a very similar way called Volt, which does the whole process slightly differently. Whereas Flipper take charge of the whole switching thing, so they just do everything for you. Volt will prompt you with the deals, and then you can decide to click a button and switch, or you have to call up. And now, what's interesting is about the reason there are differences is because of how they're paid. Anybody, price comparison sites get paid probably £20 to £50 for you switching your energy bills. So they don't do it for love, they do it for money. And all the people out there who do it, Martin Lewis, that's why they do it. And that's why they also do these big switches where they get loads of people, they get together and they use economies of scale because they get paid lots of money. What these guys are doing are trying to obviously make money by doing that. Well, Volts does, by making it a bit easier by looking for the deals for you, and then you can click to change on a good deal when they get paid, or if they don't get paid, you have to ring up the company yourself and do the energy company yourself and do that bit. So that's fine, that's just the way it works. But Flipper's slightly different because there's an annual subscription, and they don't get paid by you switching the energy deals from the providers. You pay £25 a year, and they will then do that flipping process. So it's slightly different. I quite like the clarity of that model. But I'm just throwing it out there for people who want to explore alternative ways. They're bored of switching their energy bills. We all do it. I put it off for about 6-8 months this year, and it's quite a novel way of doing it without you having to put any input, but you do have to pay for it.
I quite like the sound of that because the thing that puts me off changing my energy bills is the whole it's the calling up and the clicking through and the checking the... I know a lot of these price comparison sites will do all of the checking of the tariffs for you, but there's still no getting away from the fact that you do have to invest some time in it and clicking buttons and putting addresses in and filling in forms. If you can do that once with Flipper and say, there's your £25, you go and do with it, you just notify me when it changes. I like that.
Yeah,
I really do quite like that.
I do. It's the lazy man's. But I'm a bit of a fan of Lazy Ways to sort your money. And as I say, I've not used them, so I don't know what they're like. I mean, Martin Lewis's Energy Club, we mentioned before, does some of the stuff that Volts does. It does notify you and whatever. You can sign up, but so I'd always favour that. But yeah, I like these. I like Lazy Ways. It gets my at least my attention.
Yeah, very good. Okay, I still haven't switched. I've got the letter. We
After
talked about it a few
all we
weeks
talked
ago.
about, Andy.
I know. I still haven't done it. It's there to be done. I might go and have a look at Flipper now, though. I'm so flippant. Yeah. Oh well. Okay, so that's it. We're done.
We are done, Andy. I did I don't know. It felt like a blast of investing questions and everything. So do send in your questions on Twitter. because I do answer them. I answered one. If you go back and look at my Twitter feed, you can see the questions actually. And I did an inheritance tax one. Of all the things to talk about on Twitter, I must have raised the bar slightly on what was normally. I think it's fluffy kittens and stuff like that. But I managed to raise the bar to inheritance tax, and also it's the budget this week. Don't forget that, people. I'll throw away comment he has at the end. It's the budget on, I think, Wednesday. So we will probably do a piece on that next week, Andy, just to sort of give people a roundup. So it's a bit of moving away. We'll ignore Brexit for a while. I think the papers will give that a break. We're going to do budget.
Yeah, we did last year. We did. I think the title of the podcast was "The Budget in a Nutshell." So maybe we'll do a piece like that.
Yeah, you seem to be good today at coming up with the sound bites for these things. We'll maybe come up with another name. But that's it. Till next time.
Right. See you next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.